financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or both. Call Gene at 855-411-0424. You can also follow him on Facebook, Twitter, and LinkedIn.
Good evening, everyone. This is your host, Eugene Bias, and Let's Learn Money. Tonight is a very interesting night, a very special night. Thank you to my audience out in Radio Land, our Facebook viewers. Welcome aboard. We have a very packed schedule tonight that I want to thank everyone for joining us on here, where we learn about money. And tonight we're not going to be only speaking about annuities and savings and different types of savings. We will also be speaking about a number of behaviors. Okay, we would look at things like perpetuity and indicative. Okay, so each one share with one. Then we'll get into what's called subjective savings, things that's not discussed in our families, and the dining room, and in the community. So without further ado, we'll move right into our show tonight. We have a couple of people that should be joining us later on in the show, and hopefully they can add some value to the show. At this time, I'd like to acknowledge a few people. The Fossil Group and Ms. Tyler and Jeff for giving me the opportunity to work alongside them and developing my business, and I appreciate it. Let's talk about annuities first. Last week's show we spoke about annuities and we didn't get to complete it because we had some technical difficulties. I want to apologize for those technical difficulties and ask everyone to forgive us. As due to circumstances beyond my control, we experienced such difficulties. At this time, I'd like to get into details with annuities versus mutual funds versus 401ks. So I want to start the show this evening on a high note, and I'm hoping that everyone can hear me clearly as we go forward, as we move into our segment. Annuities, and I'm starting with mutual fund tonight, because a lot of people are familiar with mutual funds, but they're not familiar with annuities. So I'll help you out. Annuities and mutual funds share similar characteristics, but they are completely different financial instruments. They're completely different financial instruments. They're intended to detect distinct purposes. Okay? They are for distinct purposes. Okay? An annuity is an insurance product that provide the contract holder with a lifetime guarantee of income, whereas a mutual fund is a company that invests shareholders' money into a portfolio. So there are massively big difference. They share similar characteristics, but they are different. Okay? Annuities and mutual fund each have a place in savings and investments. In most cases, however, one may be better fit than the other. And it all goes back to what we originally spoke about, your risk tolerance. Okay? What kind of risk are you willing to take? What kind of risk you can tolerate? And your retirement timeline. So we have to look at the risk tolerance and the retirement timeline to determine whether annuity or mutual fund best fits your financial plans. Okay? There's a number of different annuities. Okay, there's a number of different annuities that you can look at. Annuities are contracts issued by the insurance companies. They are designed to provide guaranteed income during a person's retirement years. Guaranteed income. And have added benefit of normal growth as compared to an equity environment. The customer nature of annuities make them ideal for people who have specific retirement and planning goals. Again, we come back to planning our goals. Okay? We can do a number of things with annuities. Okay? We can do lathering. Okay? Lathering an annuity is a financial strategy of purchasing several annuities of low value over a period of years. So over a period of time. So you don't have to take a lot of money or have a lot of money to buy an annuity or to buy annuities. You can start very small and grow into the amount that you save into that annuity. When interest rates are low, lathering can offset the small return from the annuity by allowing the owner to stagger the end date of the contract. Okay? So we did speak about lathering with when we had our guests on prior with life insurance. Now we're talking about annuities, and because annuities is an insurance product, it allows you to lather also. Annuity arbitrage is a sophisticated financial planning technique that can be used to transfer wealth out of an estate tax-free and create income for a living from a surviving spouse, and other beneficiaries. Now, one of the things we spoke about last week was we touched on second person insurance. All right. Tonight we're not going to get into that. Tonight we're concentrating on annuities, but just to give you a synopsis of where we were in the past and how it's coming back again in a different form of savings. Okay? It's remarkable simply to implement. An investor purchase an annuity and use the income from that purchase to purchase a life insurance policy. The insurance significantly leverage an investor's asset because the death benefit purchase is considered larger than the cost of the annuity. So we have to think about how we are going to save our money and what we're going to do with our money from time to time. Okay? When you're looking to provide a legacy benefit, okay? When you're looking to provide a benefit of legacy, okay? Who buys annuities and attract in general, people who buys annuities are attracted to four key benefits. Four key benefits. One, principal protection. The principal protection that you get from an annuity. So your initial investment, your principal investment is protected. Income for life. With an annuity, you can set it out to pay you income for life upon retirement. Okay? Legacy to beneficiary. When you pass, depends on the structure of your annuity, it can continue paying a legacy amount to the beneficiary, whether it's lump sum or over time. Okay? And it can also pay long-term care. It can also pay for long-term care. We all are getting younger, as it would be set out sarcastically. But at some point in time, we will need some sort of care. And by having this type of account is either going to a facility that we choose, that we're comfortable with, or bringing the hospital to the home so you can relax comfortably into the confines of your own home the way you want to be, how you want to be. The United States Securities and Exchange Commission, the SEC, defines a mutual fund as a company that brings together money from many people and invests it in stocks, bonds, and other assets. Okay? The combined holding of stocks, bonds, or other assets the fund owns are known as its portfolio. Each investor in the fund owns shares which represent a part of the holdings. So again, it's governed by the SEC, the Security and Exchange Commission. But we have to look at how the mutual fund works. Unlike a deferred annuity, mutual funds do not grow tax deferred unless they are part of a qualifying plan, such as an individual retirement account. Most employers sponsor retirement plans, invest in let me start from the top. Most employers sponsor retirement plan, invest employees' money in mutual funds. Most. Okay? Now, the Financial Industry Regulatory Authority, FINRA, note, mutual funds are a particularly popular way of investing in securities, but mutual fund can offer built-in diversification and professional manage. They offer certain advantages over purchasing individual stocks and bonds. Certain, not all, the advantages. But like investment, in any security investment, in a mutual fund involve certain risk. Again, back to your risk tolerance, including the possibility that you may lose your money. So, if you have a very low risk tolerance, a mutual fund may not be as lucrative or attractive to some, while they will to others. Mutual fund offers no guarantees. So annuities guarantee, mutual fund no guarantees. Instead, they offer advantages such as diversification, liquidity, flexibility, and professional investment management. Professional investment management. Okay? So we need to look at that and think about what we want to do, what our tolerance levels are. Okay? Returns from mutual funds are realized as dividends, capital gains, or sales of funds share. Okay? We need to think about those when we look at stuff like that. Okay? We need to take those things into consideration when we look at stuff like that. Okay? Many people need to understand the difference. Many people need to understand the difference, but they don't. So we need to take into consideration how we're looking at diversifying our money and our income. Savings are very important. Savings are very imperative. Because if we don't save, we can't have. Okay? Another big difference is that an annuity offers a guaranteed payout as long as you live. As long as you live, you have a guaranteed payout with an annuity. This means, at least with most annuities, you cannot run out of money in your golden years. So if you put money into your annuities now, and you grow it and watch it grow, you will not run out of money in your golden years. That means that a 401k, what I tell clients to do is find out from your employer about your 401k and what kind of fund it's backed by or it's invested in, the investment of the earnings on your 401k. Some companies allow you to roll half of it if you're still with a company into something more that's paying more than the company current standard. Okay? So we need to look at that and understand what we are doing in terms of annuities. Okay? The main drawback are long-term contract, loss of control over your investment, or no interest earned on your investment. And again, that's where you look at what your tolerance level are. Okay? You have to wait until you age 59 and a half to withdraw your money from the annuity without any penalty. Well, if you're working and making a reasonable salary, then I don't think that you need to withdraw money from your annuity unless there's a real dire emergency before your 59 and a half birthday. Okay? Now, let's talk about principal protection. If lifetime income equal principal protection and transferring risk are items that you want to you get a contractual guaranteed, then annuities may be the right way to go. Okay? Annuities will be the right way to go if you was to look at transferring risk and maintaining certain contractual agreement. Okay? If you want to keep up with your contractual agreement that guarantees your money coming back to you, then an annuity will be the best thing for you. But we're going to go into other savings plan, okay? And we're going to do some compare and contrast, okay? So we just talk about mutual funds. Let's take a look at, and this is a key takeaway that I want everyone to think about. Okay? Let's look at IRA. Is an IRA a good idea? Is an IRA a good idea? Well, I would say both an annuity and an IRA offer tax advantage. And by having a tax advantage is offering you a way to save for your retirement. An IRA is an account that holds retirement investment, while an annuity is an insurance product. Annuity contracts typically have expenses, more expenses than an IRA, but both don't have annual contribution limit. So you can put as much money as you want into the IRA. You're not limited to what you can put in the IRA. You can place your annuity inside a Roth IRA, and that can lessen your risk while saving for retirement and generating tax-free lifetime income during retirement. It can lessen your tax-free lifetime income during retirement. So these are things that we have to think about that no one ever talked to us about, that we need to look at and be sure we have an understanding that we can live it. Okay? When you look at what kind of investment they're making, okay? Some would say they're making great investments investing outside of the REM. They'll say they're making great investments investing outside the REM. Okay? We need to look at everything. We got to look at the overall picture. And looking at the overall picture is understanding where we are, what we're doing, and how we're getting there. Okay? We need to understand that very clearly. And in understanding that very clearly, we need to make the necessary adjustments as to where we are, where we need to do. Because income annuity requires you to lose control over your investment. Income annuities allow you to lose control over your investment. So these are things that you got to take into consideration. These are things you have to look at. These are things you got to be concerned about, because going forward, this is where you are mentally, emotionally, and financially with the decisions that you make. It is imperative that we know what kind of decisions we're making, because there are different types of investments. There are different types of savings. Which one best works for you? You need to know what your tolerance levels are, what you can tolerate, and what you can do. Okay? Now we're gonna take a short break. We're gonna have a short break, and we'll be back after this very, very brief message.
EHB Services LLC for all of your financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or both. Call Gene at 855-411-0424. You can also follow him on Facebook, Twitter, and LinkedIn.
Welcome back to our show. I'm your host, Eugene Byers on Let's Learn Money. Tonight we're learning about savings, we're learning about money and how it works, and the different vehicles that we have access to that we can use in order to move our life forward and be prepared for our retirement. The next thing we're going to talk about is annuities better than a CD? Is an annuity better than a CD? Well, I'll give you the information, and I'm sure you'll make the best possible decision with the information given to you. It's a difficult question to answer depending on the specific financial goal and situation. The specific financial goal and situation. However, annuities can generally provide greater potential returns than a CD. An annuity can provide greater financial return than a CD, but there are some that comes with risk. If you are looking for a safe investment with guaranteed return, a CD or a fixed annuity will be good. So if you're looking for a safe investment with guaranteed return, a CD or a fixed annuity will be good. And we spoke about different types of annuity, variable annuities, deferred annuities, all that stuff. This is specifically on fixed annuities. Okay? So when you look at equity, there's fixed annuity, life annuity, equity, and longevity. You have to look at what you want out of retirement. Okay? And you need to understand what they are and what value they bring to you at what time of your life. Okay? When do you want the money? How much money you want to put in? How much money you expecting back out? And the length of time. Because remember, a CD is a fixed term. It's for a fixed term of savings. Usually pay much higher. An annuity, okay, a fixed rate annuity acts much like a bank certificate on deposit, but usually pay much higher than CDs on the same term. Okay? Fixed rate annuity acts like a bank certificate on deposit, but usually pay much higher rate than CDs of the same term. So again, you need to look into that and see what you're looking for. Okay? There's no magic to this. The only magic to this is the decision that you make based on your specific your specific need for retirement. Okay? Like a CD, a fixed annuity pays a guaranteed interest for a set period of time, usually 3 to 10 years. There's no sales charge, so all the money goes to work for you immediately. The interest is tax deferred. Tax deferred. Okay? A 3-year annuity is safe or can be safe. In most cases, they are safe. Fixed annuities are meant to be long-term retirement savings vehicle. So if you want to have a long-term retirement, the best preferred vehicle would be a long-term vehicle. They provide a safe, tax-advantage way to earn a good return on your savings needs soon, very quickly. They can be very effective provided that they have the guaranteed interest rate. They provide a guaranteed interest rate. Okay? Because it provides a guaranteed interest rate, between a CD, right, a bank certificate of deposit, and an annuity, there are two major differences. Fixed annuities are tax deferred and often provide a higher return than the bank CD. But you can roll that CD into a fixed annuity, okay? Or exchange it. You can roll it or exchange it for a fixed annuity. So it's very important you know what you want to do and how you want to build cash to put wherever you would like to put it. Based on the teaching you're getting here, you can make a very informed decision as to what you want to do with the money and how you want to do the money. You can look at different payouts. You can look at different payouts. Some payouts are better than others. Some payouts are clearly better than others. You can take a lump sum payment or you can take a monthly payment. Okay? You can distinguish because you're in control how you want the payout to happen. A lump sum allows you to collect all your money at one time. All once. Done. Boom. One check, there you go. Don't spend it all in one place because there's no more to get. On the other hand, an annuity is a series of steady payments that are made at equal intervals over time. Equal intervals. So the time period could be weekly, monthly, or yearly. Weekly, monthly, or yearly. Depends on how you like your money. You are in control. An annuity allows you to regularly collect part of your money over a pre-specified time frame. So we have to look at the time frame you want, the average time frame that you want to be paid out, and how much you want to be paid out at to know how much you need to have in there. So my best advice is to start to think about your pension pot. Your private pension pot. and start working towards building that pension pot. Okay? By having a savings that you don't have access to on a daily basis, a savings you don't have access to regularly, a savings that doesn't have a card associated with it. Because when you have a card associated with it, we tend to use it. Okay? So we need to take those things into consideration. Okay? We can start with a money market account. It's available to us. We spoke about CDs. We spoke about savings account. But now I'm feeling a little risky tonight. So I'm going to hit everyone below the belt. How many people have a health savings account? A health savings account. How many people know what's a health savings account? Well, let me help you. A health savings account is a tax advantage medical savings account available to taxpayers in the United States who are enrolled in a high deductible health plan. High deductible health plan. The funds contributed to an account are not subject to federal income tax at the time of deposit. At the time of deposit is not subject to federal income tax. So you can take money and put it into towards your future costs for your health and don't pay any taxes on it. It's not a flexible spend account. It rolls over and accumulates year to year if you don't spend anything from it. And it's owned by you, the individual. Okay? So you own the account. You decide how the account must be administered. You choose what you want to do with that money. Do you want to put the money in an individual retirement account, an IRA? Are you keeping that money? What is your future cost for health care? What is your future cost for medication? What is your future costs for specialist care? As we get older, our medical bills start to increase because we start to get different ailments, the aches, the pains, the big six, all that good stuff. How do we do that? So if we plan it correctly, we'll be able to have money for future costs, future healthcare costs, that is most important to us when it's most needed. So we need to look at that. We need to be sure that we have what it takes in order to do what we're doing and be able to see where we are and what we would like to do. Equally so, we need to also think about what we're going to do in terms of best practices. How do we handle our finances in a reasonable way? In a reasonable way. Now, we have to look at ourselves. As someone says, savings Is it subjective or is it indicative? Savings is either subjective or indicative. I don't think you guys are there with me yet. So, we need to look at where we are, what we're doing, how we're doing it in terms of savings. Our pension guarantees we have to look at. Our investment guarantees. Are we investing a lump sum? Are we looking for a lottery payout? Are we looking for options? Okay? Are we looking for weekly, monthly, yearly payouts? What do we think our cost would be to live? What would we be living on? Okay? We need to plan that. And we need to look at simple math. This is not rocket science, I can assure you. It sounds like a lot. It sounds like it's impossible, but it's everyday life. You either do it now and enjoy it later, or you don't do it now and you beg me later for help. Okay? It may just be too late. Having a savings does not mean that your credit must go to blows. Having a savings does not mean that because you have a saving, you must spend it. Okay? Having a savings is what we talk about is being debt free and having money there for when you need it. Okay? Having money for when you need it. We have to think about inflation. We have to think about inflations. Right now, gas is averaging $4 at the lowest per state for regular. $4. So how can we look back when gasoline was $2 a gallon and feel that we had sufficient money? Then we won't be able to leave the house because we don't have sufficient money to buy gas to operate our automobile to go anywhere. So again, these are things we have to take into consideration. And there's maps, pictures, and graphs that you can look at to tell you where you need to be, where you should be, and where you can be. It's very important that we look at these things. Okay? Also, there's a number of companies out there. To choose from. There's a number of companies out there who has a number of different niche programs that can meet your needs from time to time. There's a number of companies out there at the same time that run different training programs on investment. Okay? You just have to align yourself with those companies. You have to think about your pension. You have to think about annuities because those are the only vehicles I am aware of with guaranteed distribution. Guaranteed distribution. Once you have a financial need. So if you want to diversify and you got a high tolerance for the market, then go for it. Go for it. I will never tell you no. But I would say have some money, some resolves in an annuity, okay, some would call it a slow burner. I call it my burner. Okay, I know a lot of folks that are critical about annuities, but I don't bear the same sentiments with them all because it has its pros and cons. And the pros that I see outweighs the cons. Annuities offer guaranteed income and a guaranteed rate of return. And they are diversified in its own way. But I don't have to worry about it. I don't have to look at it. I make the regular deposits into the annuity account, or I put a lump sum in there and watch it grow. And it does what it does, what it's supposed to do. So it's very, very important that we look at these things and understand what we're up against. Okay? Some people say, my 401k. Okay? 401k, great. But that's taxed now. Okay? Where are the complications? Okay? You want to have investment options. So you want to be able to get a life insurance, to get an annuities account, okay? To do IULs, okay? And be able to save large amounts of money, growing ridiculous rates that you can't get in a bank. The rates you can't get in the bank, you get there. Save the money. See, an annuity is good when you don't have when you don't have adequate liquid savings. When you don't have an adequate liquid saving, it's good to have an annuity. Because it works best when you use a portion of your savings to purchase the guaranteed income an annuity can provide. However, buying an annuity would leave you without enough savings to cover unexpected expenses. Then an income annuity may not be the right choice for you. So you have to look at it and see what's best for you. Okay? It's not one cut fit all. That's why there are multiple saving involved. There are simple IRA. Pardon me. There's set IRA. There's traditional IRA. And there's Roth IRA. Okay? We need to make sure we make the best possible decision as to how we're doing it, what we know about each plan or each vehicle that we choose to use, and make smart decision choices towards our retirement. So I want everyone to consider what they would like to do, how they would like to do it, where they would like to do it, in order to make the best possible decision for their money. Okay. Time is running away and leave us. So at this time, we're gonna take a very short commercial break, and we'll get into some questions. We'll get into some questions and answers um, on the current topic being discussed. So everyone, I'll ask you to please get your questions up so we can get into it and get you some answers. After these messages, we'll be right back.
EHB Services LLC for all of your financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or both. Call G at 855-411-0424. You can also follow him on Facebook, Twitter, and LinkedIn.
Welcome back to our show. I'm your host, Eugene Bias, here with you. We're talking about Let's Learn Money and all the things that goes along with learning money. Tonight we're talking about savings for our future, saving for future costs, and our financial responsibilities to ourselves and our loved ones in future years. At this time, we're going to go directly to our viewers on Facebook. I'm getting bombarded with questions here. Okay. I'm going to take 4 questions from the from Facebook and 4 questions from the dial for those who dialed in, and see how best I can answer it. The first question is 401k and annuity, which is better? Ooh. Okay, great question. Great question. There is no better of the two. There is no better of the two. They're choosing the right way to save for your retirement is based on your personal needs. Your personal needs. It's easier said than done. It's your personal needs. There are many options available with annuities and 401k plans being some of the most potent. While 2 popular retirement saving vehicles are similar in some ways, they are importantly different, as well as time you can best use them. So you got to take into consideration when you can use them. Okay? What would generally make or break the two? If you have specific questions, a specific question of what would break the two, yeah, you need to make an appointment to meet with me, and we can discuss this in greater detail. Okay? You can make an appointment to meet with me, and we could get into more of the 401k an annuity based on your situation. All right, so if you give me a call on 855-411-0424, make an appointment. We can sit down and have a chat. Okay? Okay. The next question is, when should I choose an annuity or a 401k? Okay. Well, as recent as 2021, there's a study that say that annuities could be a good option for retirement as you shift assets away from stocks. Okay, so if you look at the beating that the stock market been taking lately, an annuity would be a better route because you'll be shifting your assets away from stock. There's strong evidence that household holdings, more of the wealth is guaranteed income spending significantly more each year than retirees who hold a greater share of their wealth in investment. So we got to look at, if you look at statistics, you'll find out that, an annuity is in this day and age is better than a 401k. Okay? But also you need to not forget and integrate your Social Security payment into your retirement plan. Okay? Even though it's not counted against your Social Security, you take it into consideration to see how much money you're going to have. And those are things that most of us don't think about. Okay? We need to know the contribution limit for 401k in 2021 was $19,500. It typically goes up with inflation. Okay? So if you're 50 years and older, you can add another $6,500 as to catch up with your contribution. It's based on how you have money. Yeah? It has a contribution limit. Annuities, you put where you want. So there are different things to look at the same time you considering either an annuity or a 401k. Yeah? The next question that I'm going to take okay. This one is a technical question. So the person is asking, should I move my 401k to annuity? If lifetime income and principal protection, I think I went over this before, but I'll go it over for your edification. If lifetime income and principal protection are transferring risk, are items that you want to be contractually guaranteed, then an annuity might be right for you. Okay? If not, then transfer your 401k assets to an IRA and manage the money. If you want to do the management, you put into IRA. The decision is really as simple as that. It's up to you what you want to do. Okay? So all I can do is basically give you the information and you make the best possible decision that you could make with the decision as provided. Okay? Okay, so we had 3 questions so far. Okay. Nice one. What is the difference between an annuity and retirement? What is the difference between annuity and retirement? An annuity is a financial scheme that will pay a set amount of cash over a defined period of time, whereas a pension is a retirement account that will pay cash after retirement from service. So let's get into this a little bit. I love this question. An annuity is a financial scheme that will pay a set amount of cash over a defined period of time. A pension is a retirement account that will pay cash after retirement from service. So after you're no longer in the job. But if you have an annuity account, you could still be in the job and still draw that money. Pension amount is received only after retirement, whereas to get an annuity amount, person need to wait until their retirement. I love your question. Great question. It made me think for a second. Okay. There is a number of alternatives. Oh, sorry, I didn't read the question. The final question from Facebook. What is better than an annuity for retirement? Okay, what's better? All right, let's see. Some of the more popular alternative to fixed annuities are bonds, certificate of deposit, retirement income funds, and dividend paying stocks. Okay? Like fixed annuities, these investments are regarded as relatively low risk and low income oriented. Low risk and low income oriented. So again, the lower the risk is low your turnover, is low your rate of return. So with that, we need to think about what our tolerance levels are and where we would like to be. Okay? So I hope everyone are with me and they understand where we are and what's going on here tonight. I know we ran over in the first segment for a little bit. I hope everyone is listening and understanding. I'm going to take a brief commercial break and get right into the next segment. Right into the next segment after these few messages as we move into our second segment. Thank you.
PhD Services LLC for all of your financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or both. Call Jean at 855-411-0424. You can also follow him on Facebook, Twitter, and LinkedIn.
Welcome back to our show. Welcome back to our show. This is Jim Bias on the controls. Hosting, let's learn about money. Let's learn money. Financial talk. Block Talk Radio. I'm glad that you can join us this evening. Whether you're on Facebook, you connected to Block Talk on the dial. I see my switchboard is lighting up like crazy. But it seems like we're running out of time in the first segment. As we move into the second segment, I'll introduce the second segment to you. We're talking strictly about savings tonight. Savings for different things, different types of savings, and how we can set milestone savings to protect our legacy, protect our finances, and maintain our dignity and pride during our golden years. How do we protect ourselves and the future? We're talking about saving protection. So we're going to use a couple of words tonight to describe a couple of different elements in our segment. And one that we're going to use tonight is subjective savings. So someone says, how important is subjective savings? Well, let me start with this. There's objective savings and then there's subjective savings. You don't have to be rich to save money. You don't have to be rich to save money. On the relationship between objective versus subjective financial situation and having a savings, it's very simple. By having a savings, it protects you from getting into debt. It finds that the latter situation increases precautionary savings above and beyond the effect of real income uncertainties. Real income uncertainties. It gives you the money you need to pay for unexpected expenses. Unexpected. Your car don't tell you when it's going to break. And for those of you who like to chew on beef bones and lamb bones, you know, you lose a crown, you lose a filling, dental expenses, or even something as common as property tax increase. Without cash on hand, most people go into debt because they pay unexpected bills and expenses with credit cards. They use credit. And when they use credit, they don't have the discipline, or they don't have a vehicle to repay that credit timely. Now, when we look at the 7 milestones, we look at paying off debt. And we talk about a couple of different formulas. So someone says, what income should go to my savings? When you work, at least 20%, at least 20% of your income should go towards savings. And you should be able to live 50% at maximum should go towards necessities. 50% rent, car note, insurance, water, taxes, all the things that you have to pay to live are necessities. But the difference between eating out and shopping and preparing it at home, those type of discretionary spending should only attrose to 30%. So this is called the 50-30-20 rule of thumb. The 50-30-20 rule of thumb. And that provides a quick and easy way for you to budget your money. So as long as you're on a fixed income, a fixed net income, you should be able to budget your money into 50-30-20. As long as you're able to do that, you should see a reasonable savings. Reasonable savings. So we need to know, where is that savings and how are you doing the savings? How are you making the savings? You need to also give it some great thought as to how you can improve your 20-30 and your 30-20 by lowering your discretionary percentage and increase your savings. You want to save more money. Saving money is vital. It provides financial security and freedom and secure you in a financial emergency. Financial emergency, because you have a savings. By saving money, you can avoid debt, which relieves stress. If you avoid the debt, you relieve stress. However, despite knowing the importance of savings, we often lose sight of it and spend more of our money in the present. We spend more money. Okay? So we have to look at our spending habits, our spending pattern. How do we spend? What do we spend on? Are we subjective to regular or irregular spending habits? These are things that we need to look at. Savings versus paying off debt. How to prioritize your financial goal. How do you prioritize your financial goal? I can't tell you how to do it. But I can tell you that you need to prioritize your savings. To prioritize your savings, your first priority should be saving up an emergency fund of 3 to 6 months worth of expenses. So whatever your expenses is per month, you should save 3 to 6 months of it. You should have that saved. As soon as you have enough, you should put in a money market account or a CD. So it would earn more interest that way. Okay? You want your money to work for you. So it's not just saving. What do you do with the savings? Yeah? You want to put it somewhere where it works for you. Okay? And still keep it somewhat liquid. It would be nice if most of us have the luxury of allocating no more than 50% of our take-home pay to our essential expenses. 15% of pre-tax income to retirement savings. 15% of pre-tax dollars for retirement savings, and keep 5% of our take-home pay to short-term savings. If we can do 50, 15, 5, that's an easy trick for saving and spending investments. Easy trick. Easy. Simple math. Okay? And then you look at your growth path. How do you grow that money? What is your tolerance level to grow that money? Because important of saving money, it allows you to enjoy greater security in your life. If you have cash set aside for emergency, you have a fallback plan should something unexpected happen. If you have a savings set aside for discretionary expenses, you may be able to take risk or try new things. Because it's a discretionary savings. That's what you use it for. Discretionary. And when it's done, it's done. Or when you meet your tolerance level, you meet your tolerance level. The first thing people should do is pay down their debt. Pay it all off if possible. If not, pay off the highest interest rate item first. Like credit card balance. Pay off the debt of your highest first. Can help you save a lot of money in the long term. The highest first. So don't arbitrarily choose an account that you feel you can pay and, okay, I'm going to pay off the Visa card and the MasterCard is higher, or vice versa, or the Amex is higher. You will go into debt on the long term. The biggest consequence of not saving any money is that debt will almost be inevitable for you. Going into debt is almost like a byproduct of not saving money. It's hard enough to stay out of debt for those of us who do save money. It's hard enough to stay out of debt. What about those who does not save money? Okay? For those of you who are new to the call or to the financial talk, I welcome you aboard. Join us every Tuesday from 7 to 9 Eastern for these financial talks. You can log in on Facebook Live to see my lovely face and for you to be able to take notes. But also like to invite you to embark with me, and those of you who have started, on this journey of saving and protecting our family, building a legacy for our family. I challenge each and every one of you to follow me. I do it, I enjoy doing it, and I invite you all to do it. The 70-30 method. I applaud, I embrace the 70-30 method, because that method you can see more, and it calls for allocation and discipline. It's a budgeting technique to help you allocate your money. If you take 70% of what you earn and put it into spending, which include all your bills, all your luxuries, 70%, and 30% of your earnings go towards savings. My. Well, some people thought 15 was bad, 20 was hard. Join me at 30. The easy saving technique of how to use the 70-30 rule, I can show you hands down. I can teach you hands down. All you have to do is book an appointment with me, and we can sit down and plan it and get it done over time. Now, there's another way to look at it, and the other way to look at it is very simple. On the same technique, why not 30% of your income? Pay all your bills. Whoa. Pay all your bills, and you're able to save 70%. 70% of your income. How hard could it be? It called for some sacrifices. It called for some readjustments. But at the same time, it gives you that peace of mind and stability that you're looking for and you need. At the same time, it allows you to have a greater peace of mind when you retire. You have to know. You have to know where you would like to be financially. You have to know how you would like to get there financially. What if it means to have 100,000 in savings? Having $100,000 in savings means you have a good amount of money saved up that you can use in case of an emergency. But can you retire on $100,000? How much money will you have upon retirement when you spend $100,000? How long, how far will it go on $100,000? So my challenge is let's put $250,000 aside. Let's look at what it takes to put $250,000 aside. Can we live on that? Can we retire at age 55 at $100,000 and be comfortable? Can we do it with that? Can that do it for us? The answer is yes. Would we struggle? We can. Depend on our lifestyle. What kind of lifestyle change and adjustments we would have to make? Those are the questions that need answers. But let me give you the fast answer. A general rule of thumb is to have one time your annual salary saved. One time of your annual salary saved at 30. 3 times your annual salary saved at 40. And so on. That's the fast answer. So if you want to know how much money you're saving or need to save, that's the rule of thumb. So if you don't have that rule in place, my friends, my listening audience, my colleagues, I'm sorry, you have a problem. You either have to work a little bit longer or cut back on a number of things. Because $250,000 per year, $250,000 in savings will generate a retirement income of roughly $10,000 a year. Using the 4% rule. Okay? Using the 4% rule, you'll roughly have $10,000 per year. So I need everyone to think about it, to consider it, what they need for retirement based on lifestyle and their lifestyle changes that they want to have and how they want to live. So everyone needs to take into consideration what they have, what they're doing, and what they want to do. It is also important that you become financially independent. Financially independent, where you can leave a legacy. Okay? Your savings net worth should be equivalent to at least 8 times your annual expenses. 8 times your annual expenses at age 45. So you need to have 8 times your net worth amount should be 8 times your annual expenses. Your expenses coverage ratio is also important because the ratio determines how much you have saved, because it is a function of your lifestyle. Okay? So the closer you are to the number, your goal, is the better for you. And we can sit down and discuss this in great details and understand where we are, what we're doing, and how we're doing it going forward. Okay? We can discuss it in great detail and understand what we're doing and how we're doing it so that we can make sense of it in our future and our futuristic goals. We need to clearly, have a clear understanding as to what we're doing, how we're making our decisions, and how we're choosing. Because our choices today is what we have to live with in our golden years. Not our choices tomorrow, our choices today. At $300,000 and 62 years old, can you retire with that amount? Yes, provided you are prepared to accept a modest standard of living. Okay, you have to make some adjustments. If you want to have a modest living, 300,000. Okay, and we're not considering today's inflation. So when are we going to start saving in order to do so? I need everyone to think about those, ponder on those words. Think especially as to what they're going to do going forward, because it's very important and imperative that you know what you're doing. It's important that you make the wisest possible decision. It's very important to make the wisest possible decision you can, given the situation set out and described in these matters. You have to look at it. It's something, if you don't look at it, it will be dictated for you. Okay? Now I want to look at indicative. Okay? Indicative. When you look at indicative quotes, is a reason to, like cryptocurrency, an indicative price of crypto. Everybody's talking about crypto. Yeah, an indicative quote is a reasonable estimate of a currency current market price that is provided by a market maker to an investor upon request. Okay? Now I'm touching on this I'm treading on this one very lightly because it is important to know that an indicative order means forecast of anticipated requests for the transportation shipper manuals. We need to look at what they're forecasting a price to be. Okay? We need to look at what they are looking at in terms of the trade. Okay? So, Bitcoin and other cryptocurrency are more on an auction mode, from my understanding. So it's more of a cryptocurrency instead of your traditional currency. A lot of people want to invest in it, but these assets are usually forfeited by federal, civil, administrative cases and are up for auction. So I like to play it safe. I like stuff that are backed by years of experiences. I like stuff that are controlled and regulated. I'm a regulatory guy. I like the regulatory stuff. Okay? So we need to understand where we are in this spectrum of savings, okay, or investing to make a saving or to have a savings. Where is the perpetuity used? Perpetuity is used widely by companies to properly place a value on various investments such as stocks, bonds, real estate, and especially annuities. With perpetuities, payments from those investments theoretically never stops, making perpetuity a stream of cash flow that has no end limit. So you would like to be, in my opinion, in that kind of scenario where in your golden years, when you retire, you have monies paying to you that never stop, investments that theoretically never stop. A stream of cash flow that has no end limit. So you will always have that payment coming into you at retirement. Then, pension is a type of retirement account where you keep savings throughout your entire life. That's what a pension is. On the other hand, perpetuity is an annuity that not only makes regular payment throughout the years, but the payment never ends. So when you look at the wide array between annuities and perpetuities, you can understand that they're equally beneficial into preserving your life, your living, your standard of living. Because it have the endless or the indefinitely long duration or existence, eternity built into it. Okay? An annuity pays for life. As long as you're living, the annuity pays. So we need to be able to sit down and have a conversation as to where you are, what you want to do, and where you'd like to go. So I can provide you with guidance as to what is and what can be. What is and what can be. So I need everyone to take these few words into consideration. I think that everyone needs to look at their savings. Everyone needs to be focused on where they are, what they want to do, how they want to keep their savings in place, how they want to be able to have a savings for the future, and where they would like to be financially in their life. So most people need to be concerned, very concerned about what they're doing, how they're doing it, and what they would like to do. Because it's very, very important we know how we're saving money. And in knowing how we're saving money, we can tell where we're going to be in the future. So everyone that's on the call, and I know that the dashboard is lining up, we're winding down. I need you to understand, think hard, be prepared for the tough questions when you sit with me, where you would like to be. Are you looking for uninterrupted existence? Endless duration? What are you looking for in the future? What kind of savings are you looking for? What kind of growth are you looking for? Where would you like to be? Are you looking for money today? Or are you looking towards a future? Okay? When you invest, how are you investing? Did it give you the return that you're looking for? Or do it have the potential for you to lose? What is your risk tolerance in order not to lose? What is your risk tolerance when you go into such a market? How do you lose? What do you do? What are you looking to do? It's very important you know that and isolate that. Okay, so everyone on the call, on Facebook Live, I beseech you, I beg you tonight to get some sort of savings in place. We spoke about a number of savings tonight. A number of savings tonight. I know it's a lot. There's a lot that went down to your throat. There's a lot of questions out there, and I'm sure there are. You can always send me an email, drop me a line, message me on Facebook. You need to know what you're doing, okay? Because we need to have the understanding as to what you're doing, how you're saving, and where your money is going. It's most important that you know that. Okay? You need to know where you're going to be in an ordinary annuity. Okay? Because if you decide you want to have an ordinary annuity, what is the formula of an ordinary annuity? An ordinary annuity is just a series of payments made at the end of each period, such as monthly or quarterly. In an annuity, due by contrast, payments are made at the beginning of each period. Consistent quarterly stock dividends are one example of an ordinary annuity. Monthly rent is an example of an annuity due. So there are many different payments that's available to you. If you're not a risky person, you can enjoy these qualities and you can have them available to you. Okay? You can look at your rent lease payment and have it paid through your annuity. Okay? You can look at the value of an ordinary annuity and use that total to calculate and make a determination of your payout if you want to be paid out right now. How many of us knows that? Okay? How many of us we get money such as a car accident or we get some money from a loved one, some inheritance, and we spend it all. We save none. But we can take that money and use it for many different things. Many different things, including but not limited to an income annuity. You can have an annuity where it pays you a monthly fixed amount every month. But we tend to take lump sum money as a practice. We tend to take lump sum money and spend it all one time. That's not always a good thing. Because what happened in the future? It's money that we didn't know was coming. It's money we didn't expect to come. We were going to live before we got it. And we're sure going to live after we get it. But why don't we plan for the future? A general annuity is an annuity where the payment does not coincide with the interest period. You will be able to see that is a very easy way to deal with a general annuity once an equivalent interest rate is determined, with that equivalent rate being compounded as often as the payment is made. Ooh. Heavy stuff, heavy stuff. So when do we look at what type of annuity we want? Okay? We need to talk about that. We need to understand that. We need to know, you want an immediate fix, an immediate variable, a deferred fix, or deferred variable. Okay? We need to know where we are and where we would like to go. Okay? What's the difference between a simple and a general annuity? The main difference in that is that a simple annuity, the payment intervals are the same as the interest period, while in a general annuity, the payment interval is not the same as the interest period. Simple stuff. That's the difference between the two. Payment intervals are the same, or payment intervals are not the same. So we need to look at these. We need to think about where we are financially. We need to be educated on this. We need to know how to run our numbers. Okay? When you sit with me, we'll run some numbers and I will show you how you could do the investment, how you can look at stuff, how you can do stuff and not have a problem. Because your future is what we're trying to protect. Your future is what we're working to protect. Okay? And when we look at a deferred annuity versus a fixed or a variable annuity and an immediate annuity, they're all different. They all fit different situations. And we need to be certain as to what we would like to do. Ladies and gentlemen, I am asking you, I'm pleading with you to please think about the top rate for a 5-year annuity, fixed annuity, is a lot more than what you could get in the bank for 5 years. Not to mention a 10. Okay? There are fixed rate annuities that are good to build saving safely. You don't need to exaggerate the numbers. Okay? You don't. The numbers speak for itself. And it's very clear. It's very clear that you will be happy by diversifying. It's very important to diversify. And when you diversify, it gives you lose some control. I agree. Because you don't get to make the determination of the investment. You lose some control. But what you gain outweighs the control that you lose. Let the experts do what the experts do. In 100+ years, I am yet to learn or to hear about an annuity that went south, or a company, an annuity company, or an insurance company that went south and people have lost all their money. So I'm saying to you now and forever that you need to be very careful as to how you spend, what you spend, where you spend, and think about how to save, where you can cut corners to save, where you can have more in your disposable income so you can save more. You can have more. And you can do more. These are different times. Times are changing. People are changing. And we need to have more control and exercise more patience. In research, don't take my word for it. I'm just teaching you. I'm just passing the information along. I want you to know that you are in control. And it's your decision what you decide to do. I support your decision 150%. What I don't support is stupidity. If you never heard the information, you heard it here. Block Talk Radio on the Neo Network with me, your host, Gene Bias, Financial Talk. Save, save, save. Give me a call. Let's devise a plan. Let's work it out where we collectively can have sufficient to build and grow on. I think that everyone should have the ability to retire comfortably. Comfortably. Everyone should be able to choose the lifestyle in which they want to retire. I am no pastor, but I'm a good listener. They said the Bible allows you, or grace, 70. That's 70 years. but it stated that an income annuity should start between 70 and 75 years, which allows the maximum payout. But let me tell you guys something. Only you can decide when it's time for a secured, guaranteed stream of income. So don't worry the statistics. You are in control. Make your own decision. With these few words, I say good night. See you next Tuesday. Godspeed. I'm your host, Eugene Bias, saying thank you for joining us on Financial Talk every Tuesday from 7 to 9 p.m. Eastern Time.
EHB Services LLC for all of your financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or boat. Call Gene at 855-411-0424. You can also follow him on Facebook